Hey everybody, Kyle Knott, your average finance guy, coming back to you again, kind of expanding on this example we've been playing with here for a while. Last couple of videos showed basically how to get out of the hole and get out of a lot of the credit card debt. One after that was how to keep climbing and how to build some wealth. And now I kind of wanted to just give another little visual short video of how this infinite banking policy works. Not real technical, just kind of wanted to show how the flow of money goes. So we're going back to our old-fashioned example here. Couple has an income of $10,100. Their expenses are $79.64. They got a cash flow of $21.36. Still got a mortgage payment. They've got a $25,000 home equity line of credit is still available to them. And so what we're doing here is we take our income after we're done with the velocity banking. We got all that stuff's paid off. The HELOC is paid off. It's kind of now what do you do? So now you'll take where does your income go? So maybe your income comes in here. Maybe it's your checking account. Maybe it's your HELOC. You're still working on paying some of that stuff down, and it goes into that bucket, right? So we got this steady drip. Hopefully, whatever you get paid weekly, bi-weekly, bi-monthly, but however it is, we should have this steady drip from your job of income. And down here we got all these holes in this bucket, right? You got your mortgage payment, you got your utilities, you got your car payment, your food, your phones, miscellaneous, everything else that you have to pay. All your expenses are flowing out of this bucket, right? It's just a continuous flow of money in, and it seems like money always out. So after you get through the velocity banking and start building some net worth here, what we want to do is we want to be intentional about taking some of this income and taking it out of that whatever vehicle this is, whatever bucket this is, and we want to put that whatever we could put into savings. We want to put it into our policy. So in this example, they've got 2136 of free cash flow. So I suggested with all these numbers here, we kind of ran with $2,000 a month. So if you could take $2,000 a month and put it into a savings / policy, and then the way this works is usually insurance goes per year, so it's a little cheaper. You can pay monthly, but you got to pay a little bit of cost along with that. But so we'll say it's either $2,000 a month, $24,000 a year, however you want to look at it. It really doesn't make that big of a difference. So you'll take this over into your policy. Okay, your policy here. This is what it's going to grow to if you keep continually making this $2,000 a month or $24,000 a year. In year one, it's going to be $24,660 because of the dividends. Now, these are not guaranteed all the time, but most of these companies they've all paid dividends like through the Great Depression. So if they're still paying dividends, okay, they're not guaranteed, but they pay. So they're pretty much you can bank on it. So after you do this, if you don't touch it, it doesn't matter if you touch it or not. In 30 years, you're going to have $1.6 million. So what you do here is in the policy, as this grows, you can take a loan against this at any time. This still keeps on growing. Doesn't matter. It's not like a savings account where, our last example, I think year 5, we wanted to take $100,000 out. Now, if this is a savings account, that gets whacked down to $36,000, and now you're starting back over. You're somewhere between year 1 and year 2. Okay, so from there now it's going to be another 28 years before you get to this 1.6 million. Well, what's going to happen in another 5 years? You're probably going to want to take another 100,000 out, maybe even 200,000 out. So you just restart the clock. But if you've got this policy, these numbers keep going. You can always borrow against it. Maybe year 7 you want to take out a $200,000 loan. So you take a loan out and you buy an asset. Okay, maybe this asset is this car payment, and it's a good way to knock out one of the holes. Most of these other, you got to pay utilities, you got to eat, you got your phones, whatever miscellaneous stuff. That stuff, you're never going to block all the holes unless you're living in the woods out in the middle off the grid somewhere, right? So if you can take a loan against your policy and buy an asset, maybe it's buying a rental house, and whatever you take, and you take money for a down payment. At the end of the month, you get a renter. They pay all the utilities, all the bills, all the expenses. At the end of the month, you've got $250. Okay, or whatever that money is, put that right back in to your policy to repay that loan. Okay, at some point that's going to be paid off. Okay, and you're still going to have this asset. At that point, you're dumping money back in here. Okay, And now, once you get one paid off, or you got another, maybe some more time goes by, maybe year 10, hey, that worked out pretty good. Maybe it's year 3, I don't know. Let's go ahead, let's get another asset, and then asset, pay yourself back. When it's paid back, it goes back in here. I mean, what happens when you have just, you got assets all over the place? In no time, your policy will be paid back, but these things are always cash flowing. They're always dumping more income back into your bucket, whatever that is. So that's kind of the basics of how this works. Again, these are the numbers in 30 years, putting $24,000 a year, $2,000 a month that we freed up from velocity banking gets you to over $1 million in 22 and a half years is where you hit that $1 million mark. And this was almost $1 million in dividends or interest, if you want to look at it that way, that was paid. So it's really great. In my mind, you're always making money. You're always earning those dividends while also buying. You can buy other things. It doesn't have to be rental house. I know a lot of people that lend money. They'll lend money at, if you can take a policy loan out for 6% and you can lend it out at 12%, there's a 6% spread right there. So if I could do that, I'd take out $1 billion loan at 6% and loan it out for 12%. And at the end of the day, this is going to fill up and I'm going to have to find some more stuff to buy. So it's a real good problem to have. Hopefully you got some questions, let me know, and glad to help. Good luck.